Welcome to the Hurst Trading Room. My name is David Hickson and this is a video update for the 13th of April 2015. Before we take a look at the markets, please make sure that you have read and understood these disclaimers. If you are watching this video anywhere other than on our podcast channel, then make sure that you subscribe to the Hurst Trading Room podcast channel on either iTunes or YouTube. In that way you will be notified whenever I publish a new video. The subject of this week's video, if you like, is the contrast between analysis and trading. Analysis and trading, of course, are two sides of the same coin, and many people consider them to be the same thing. You perform an analysis and then you make trading decisions. But sometimes in the markets, your analysis discussion can be very different from your trading discussion. This largely has to do, of course, with your time frame. Sometimes when you are considering an analysis of a market, then the time frame that you're considering is the same time frame as that which you are trading. And at other times, you are discussing much longer cycles and a larger magnitude time frame in your analysis than the one that you are trading, perhaps. And that is certainly the case at the moment for me. It might be different for you because, of course, you might trade a different time frame. But at the moment, the analysis considerations and the things that I'm thinking about in terms of the analysis of the market are generally of a much longer time frame than the trading that I'm doing. And I would like to highlight that in today's video, because the important thing is that you continue to make sensible and profitable trading decisions even when your analysis considerations are of a different time frame. And that is why you need a trading strategy that enables you to make trading decisions reliably and consistently, even when your analysis considerations perhaps are a little unresolved, when there is some analysis uncertainty, or you're not really sure what's happening in the analysis. And that's a very important thing, and that's why the FLD trading strategy is structured in the way that it is, because you are able to constantly and consistently make trading decisions that are reliable and are profitable, even when there is some analysis uncertainty. Now, I don't have a great degree or a great deal of analysis uncertainty at the moment by any means, but a lot of my analysis discussions and a lot of what I write about on the blog at the moment has to do with very long-term cycles. As you know, and I'm not going to go into great detail in this video, but as you know, if you've read anything I've written recently on my blog, on Hurst Signals, or on the Sentient Trader websites, and if you've watched these videos recently, you will know that I believe that in the stock markets around the world, we are approaching a very important peak, or a very long cycle peak. I've mentioned the fact that I believe that we are seeing a peak of about 9-year magnitude. Now that's quite important. I think that the markets are going to be heading down for some time. I think we need to prepare ourselves for some bearishness. We've had a very long bull run, and I think it's time to fasten our seatbelts and get ready for a move down. That doesn't mean that I am starting to sell short right now, not at all. But I believe we need to be aware of the fact that the markets might be forming a very long cycle peak. And I would like to highlight in this video how the fact that I'm expecting a very long cycle peak doesn't need to affect my day-to-day trading, apart from perhaps keeping in the back of my mind the fact that we are in the process of forming a peak, in my opinion. However, we are still able to make very consistent and reliable trading decisions. So let's take a look at the S&P 500, which is, of course, one of the US markets, but many markets around the world are following similar patterns. I like to look at and analyze the S&P 500, also the Dow and the Nasdaq. But let's take a look at this market and let's see what's been happening. Now, this is one of the analysis opportunities that I have been discussing, or at least one of the analyses that I have been discussing in these videos recently. I don't need to dwell too much on the details, but as you can see, there is an 18-month cycle trough back here in October of last year, and the 20-week cycle trough in this analysis is positioned in the second week of March. As you can see, that's what that green diamond represents, is the position of the 20-week cycle trough. Now, there is another analysis possibility, which I will discuss in a moment, which positions the 20-week cycle trough in a different place. But this is a very viable, a very valid analysis, and a very likely one in my opinion. Now, according to this analysis, what we need to be focusing on in terms of making trading decisions is we need to be looking at what's been happening since the 20-week cycle trough. So I'm going to do that, and I'm going to zoom in now and discuss the trading opportunities that we have had in this market recently and what's coming next. So the way that we approach trading once we have a Hurst Cycles analysis is, in the back of our minds, we bear in mind the long-term analysis possibilities. And if you take a look at previous videos that I have recorded, you will know that I'm expecting markets to be forming a 9-year cycle peak probably sometime this year. March was a possibility that I wrote about way back in September or October of last year. I said March would be a possible peak of the 9-year cycle. I updated that consideration and mentioned that it could be March, May, or even again another attempt at a peak in September or October of this year. So we keep that at the back of our minds. We don't worry too much about that. When trading using the FLD trading strategy, we trade interactions between price and this purple line here, which is the FLD, a line which of course stands for future line of demarcation, one of the cycle tools that Hurst defined. And price interacts in a very reliable way with that FLD. So our trading opportunities recently, or since March this year, have been this interaction here. This was a long A category interaction according to this analysis. Then price came down to the FLD in what was a B category interaction between price and the FLD. Now, a B category interaction very seldom provides us with a profitable trading opportunity. It would be a short trading opportunity, of course, if we were to trade it, but it very seldom provides us with a profitable trading opportunity, and that was certainly the case here. If we had entered a short trade at the level of the interaction between price and the FLD, we would not have made a very successful trade. All right, price came down a little bit, then it bounced back up again, and it fiddled around. It wasn't a very good, clear, a short trading opportunity. The next interaction is the C category interaction as price breaks back up above the FLD. Now, that occurred interestingly over the Easter weekend. The Easter weekend was from Friday, the 3rd of April, through to Monday, the 6th of April. Now, the American markets were open on April the 3rd. Generally considered a Good Friday. That's the first day of the Easter weekend, and the US markets were open, but they had an early close. And then the markets were open again on Monday, the 6th of April. So that looks like a normal weekend in terms of the data we see on this chart. But it's very important to bear in mind that when there is a holiday weekend and many markets were closed, particularly the European markets were closed, they were closed all day on Monday the 6th, I believe. When there is a holiday weekend, even if it isn't specifically a holiday in this particular market, but when there is a fairly important holiday weekend around the world, then you have to be very careful about trading. And so the trading that actually took place on Friday, this strong move down, and the trading that took place on Monday, this strong move up, is trading that needs to be handled with some caution, because it's generally fairly low volume trading, and one shouldn't pay too much attention to it. That's just a small detail. But at any point, the C category interaction between price and the FLD then occurred over here on the Monday as price crossed back up above the FLD. And of course, the next interaction that we're looking at is a short D category interaction between price and the FLD. It would be a short D category trade, bringing price down into this 40-day cycle trough. So in terms of our trading discussion, our trading consideration, the next trading opportunity in the S&P 500 and in most stock markets is a short D category trading opportunity as price comes down into the 40-day cycle trough. Now, that 40-day cycle trough, as you can see, is expected. In fact, the exact date, the circle and whiskers, the circle of that 40-day cycle trough, the next trough, as you can see, is the 17th of April in 4 days' time. But we don't merely look at the 40-day cycle, we also look at the shorter cycles, which together form what is called a nest of lows. Let me just clear all of that scribbling on the chart and show you the nest of lows here. So here is the circle and whiskers for the 40-day cycle, with the 17th of April being the most likely date for the actual trough to form, but it must form synchronously with the trough of the 20-day cycle. You can see a trough of the 20-day cycle was expected pretty much last night, on Sunday night or early this morning. The 10-day cycle trough was expected early sometime on Sunday. And the 5-day cycle trough was expected also overnight. So you have to consider the position of all of those troughs, and they form together what is called a nest of lows, which normally appears on the chart as a triangle standing on one of its corners. And so that is the nest of lows. That's the range of time in which we expect the 40-day cycle trough to occur. So our expectation is for price to come down into that 40-day cycle trough, at which point we would have a short trading opportunity. It would be a D category short trading opportunity. However, in considering this trading opportunity, it's important to take a look at the entire picture. I have already mentioned that I believe that markets are forming a 9-year cycle peak, which means that we should begin to see some good short trading opportunities. So in terms of considering a short trading opportunity that is coming up perhaps sometime later this week, that is one consideration, which is in favor of us taking a short trading opportunity. However, there are a few other considerations here which are important to bear in mind. The first one is how reliable has price and the interaction with the FLD, how reliable has that interaction been? I have to say it hasn't been very reliable, but let's go through that. Here is the first interaction where price interacted with the FLD. That was an A category interaction, as I've already mentioned. My pen is giving me trouble again, but that's an A category interaction, and we expect the A category interaction to fulfill its target and to exceed it. The target is calculated as the distance between the low point at the 80-day cycle trough, or in this case it was a 20-week cycle trough, up to the crossing point where price crosses the FLD, and we can simply count grid lines here. That's 1, 2, 3, 3 and 2/3 perhaps, and you would then expect the price to extend an equal distance above that. So we had 1/3, 1 and 1/3, 2 and 2/3, and 3 and 1/3. Did I say 2/3? That was an error. So price moved up about 3 1/3 grid lines up above the crossing point. Of course, we could look at prices and we could work it out exactly, but that's not important for this level of discussion. My point is that this A category trade probably almost achieved its target, but not quite. So its target was probably somewhere over here. So it almost achieved its target. The first important point to bear in mind is that an A category trade usually, or an A category interaction usually exceeds its target. It fulfills and then exceeds its target. So that indicates that the way in which price is interacting with the 20-day FLD at the moment has a slightly bearish note to it, because the A category interaction didn't, in fact, achieve its target, and it certainly didn't exceed it. The next thing that happened was the price came down to the FLD for a B category interaction. Now, what do we normally expect at a B category interaction? We expect the 20-day FLD to provide support at the B category interaction, and we expect price to track along the FLD until it breaks up above it in the C category interaction. Did that happen here? Well, not really, no, because price dropped down a little bit below the FLD. Having dropped down below the FLD, it did, as you can see, move sort of parallel with that FLD until the C category interaction, at which point it did break up above it. But it didn't track along the FLD. Now, all of these considerations are guidelines for how we expect price to interact with the FLD. The market's not perfect, and they don't always do exactly the same thing all the time. But it's important to note that, yet again, this market has seemed to be more bearish than it should have been, because price was below the FLD between the B category and the C category interactions. So that's a slightly bearish note to consider. So we have seen two slightly bearish considerations. The first is that the A category interaction did not fulfill or exceed its target, which it usually does. The second was that between the B and C category interactions, price was well below that FLD. So those are two fairly bearish considerations. What happened next? Well, price broke up above the FLD, and it went up fairly strongly for the whole of last week in what was probably a C category interaction. Now, C category interactions are a little bit complex, and it's not always possible to generate targets. So I won't go into those details here. I want to try and keep this video as short as possible. But the important thing is that that C category interaction was not necessarily a particularly bearish C category interaction. So those are some of the detailed considerations. What are we expecting next? We're expecting a D category short trade. The interactions since the middle of March have all had a little bit of a bearish tinge to them. They've had a little bit of a bearish note. And so we are also, of course, expecting a long-term cycle peak to occur. So I am looking for opportunities to enter into short trades, and so that short trade might be a very good opportunity. However, there is something else that I would like to point out, and that is well worth considering when we are considering a potential short trade here. And that is this. Here is the nest of lows for the 40-day cycle. Okay, now over here, perhaps on Monday, perhaps you could consider the previous week over here, but here was a fairly prominent trough. Okay, price bounced out of it very early. Now that's only a few days before the earliest point at which the 40-day cycle trough could have occurred. So we need to look at that, and we need to ask ourselves, is it possible that that was, in fact, an early instance of a 40-day cycle trough? Now, the answer, in my opinion, is yes, it is possible. And we'll look at it in a little more detail in a moment. But if it is possible, then what does that mean for our trading? Here we have a potential analysis uncertainty. Maybe the 40-day cycle trough has occurred, maybe it hasn't. Analysis uncertainty. Does that mean we cannot make a trading decision? No, it doesn't. That's very important, because in fact our trading decision is still going to be the same. Let me explain why. If this was the 40-day cycle trough that occurred over here, and I'm sort of fudging the details there, but it's important to fudge the details over the Easter weekend, because Easter weekend trading is a little bit unreliable. You know, you have people that are celebrating a religious festival. You have some people that are simply celebrating the start of spring, but people aren't concentrating a lot on trading. People are taking a holiday. and there is a little bit of unreliability in the trading that occurs around there. So it is, I believe, sometimes necessary to fudge the details a little bit. Is it possible that the 40-day cycle trough occurred there? Yes, it is possible. It's not beyond the realms of possibility, which means that this big strong move up here that I've been discussing as a C category interaction could possibly be an E category interaction. Now, that's an analysis consideration, and we could debate it at great length, and I probably will. But what's important is that we can still make a clear trading decision for our next trade. What would our next trade be? Very simple. Our next trade would be the F category short trade as price crossed down below the FLD. So do you see that even though there is a little bit of analysis uncertainty, my trading decision is still the same? My trading decision is that I would enter into a short trade at the point at which price interacts with that FLD. Whether it turns out to be a D category short trade or an F category short trade does not matter very much. It does matter a bit, because D category short trades tend to achieve their targets fairly accurately, and you have to be nimble and quick about getting out of those D category short trades. F category short trades, however, tend to be much more profitable. They tend to run longer, and you want to give them a little bit more breathing space to allow them to develop into good, profitable short trades. And so there is a little bit of a difference, but in terms of what our next trade is going to be, there is no difference. It is going to be a short trade when price interacts with that FLD. Now, let me just zoom back a little bit here and show you another consideration that it is worth bearing in mind, I believe, in terms of whether that 40-day trough might have occurred or not, and that is that we are seeing a pattern here. Let me show you the pattern. It's very important to recognize patterns. I tend to be a fairly visual analyst, and I look at these patterns. Look at this bounce out of October. A big strong bounce up, and then price came down to the 80-day cycle trough. Then it bounced up again, came down again, up and down, and formed what is effectively a triangle. Okay, that's quite clearly a triangle that formed in the markets. Now let's have a look at what happened following the trough at the beginning of February. We had a big move up, and then it came down fairly sharply, then a big move up, and it came down, and now we've had another big move up. Can you see a repeat of what is effectively the same pattern? A big strong bounce up followed by price consolidating in a triangle. Now, when you see patterns like that repeat in the market, and that's a particularly beautiful pattern, a very clear repeating pattern, then, in my opinion, it is a reason to sit up and take notice. And in particular, I would say, let me just clear that, I would say that it looks as if though what we saw happening over here, up to that point, we have seen happen again here up to this point. Or perhaps if the market comes down a little bit and remains within that triangle, then maybe it'll be a little bit later in a week or two. So we're seeing the same kind of thing happening. Now, according to this analysis, with the 20-week cycle trough here in the middle of March, that doesn't make a lot of sense in terms of a repeating pattern that we're seeing happen in conjunction with our cycle analysis, which is why it is time now to take a look at the other analysis in the S&P 500. And here is that analysis, and you should be familiar with this analysis by now because I've spoken about it in several previous videos. The 20-week cycle trough occurred at the beginning of February. This is still a very possible analysis, and this analysis makes more sense in terms of the repeated action that we have seen happening. Here you had the big strong bounce out of the 18-month cycle trough. Then, of course, the market went into forming this triangle. And the low point of the triangle was the trough of the 20-week cycle. Then price bounced out of the 20-week cycle and formed yet another triangle. Okay, and the low point of that triangle would then be what trough? Well, if we're looking at a clear repeating pattern, then of course the chances are that that trough there, or if price comes down and forms another trough, in other words, the trough that forms before price breaks out of this triangle might be in fact the trough of the 80-day cycle, which you can see the nest of lows for at the beginning. I hope I'm not rushing through this, but this video is already getting fairly long and I have several other things I want to speak about. But I hope that you're seeing how those repeated patterns in the market are actually potentially working synchronously with our cycle analysis. Can you see that? Here we had a big strong move up followed by a triangle. The low point of the triangle, or the end point of the triangle, was potentially a trough of the 20-week cycle. Here we had another big move up, and then here again we're going to have an end point of the triangle, which might not have occurred yet, but when it does occur is very possibly going to be the 80-day cycle trough. So let's zoom in on this analysis and measure the bars. You can see I have a bar count going there, but let me measure the bars up to that bar there on Monday. That's 63 days. Is it possible that that was our 80-day cycle trough? Yes, it is possible. How many bars do we expect in an average 80-day cycle? We expect 68 days, 68 bars on an end-of-day chart. And at 63 days, it is possible that that was, in fact, the trough of the 80-day cycle. So the markets might be bouncing out of an 80-day cycle already. So that's an important consideration to bear in mind. Now, I've spent a lot of time discussing different analysis possibilities. Okay, so if you're sitting there thinking, but how on earth do you make clear trading decisions with all these possible things going on in the analysis? Let me set your mind at rest. It is actually going to be very easy to make trading decisions. We need to take all of the analysis that we have considered and put it all into one part of your mind, if you like, and say, that's my analysis, but now what am I going to do with my trading? So let's consider that. Let me get rid of that bar count. There we go. Now, and let me highlight that. A trading decision. I've already mentioned on the other analysis that we are looking at a short trade when price interacts with this FLD. Let's stick with the analysis at the foot of this chart. You can see that according to this analysis, we have price coming down into a nest of lows for an 80-day cycle trough, and of course that would be an F or an H category short trading opportunity. And so again, we would be interested in trading the interaction between price and the FLD. So most of our analysis possibilities indicate that we have a very good short trading opportunity coming up. However, there is one possibility which indicates that we should not take that short trading opportunity. And it's an important consideration, and that is the possibility that this trough over here turns out to be a trough of the 80-day cycle. I've just mentioned how that is possible. You can see here with the circle and whiskers for the 80-day cycle, the first possible date was right here in the last week of March. So it is possible that the 80-day cycle trough has formed in the markets. Here you can see in the nest of lows the 40-day cycle trough, according to this analysis, was in fact expected over the last weekend, or towards the end of last week. And so it is possible that that 80-day cycle trough has formed in the markets. If that 80-day cycle trough has formed, then what is actually happening? Well, let's zoom right in so that we can focus on it. And in fact, sometimes I just turn off that phasing just to make it easier to consider the price movement all on its own. Let's assume that the 80-day cycle trough formed sometime in the first week of April. Then this here was an A category interaction as price broke up above the FLD. What do we expect next? We expect a B category interaction. Oh, the B category interaction. Now, that is also a short interaction, or at least an interaction whereby price drops down below the FLD, but we very seldom take a B category interaction as a short trade because they very rarely turn out to be profitable trades, as I've already mentioned. And so that is an important consideration. So how do we make a clear trading decision? Well, let me zoom back out again, and let me turn on our phasing just to make this clear. So here is the trading decision, the clear trading decision as far as I am concerned. This is my trading decision. Let me just go back to the other chart. Here we go. I believe that this is the most likely analysis over here with the 20-week cycle trough that formed in March. And our next trading decision would be a short trade. Let me just display that FLD so that we can see it. Here we go. A short trade as price crosses down below this FLD. All right. It would be either a category D or perhaps a category F short trade. It doesn't matter very much to me whether it's a category D or a category F short trade, but that is the trade that I'm interested in taking. However, I must bear in mind the possibility that either a 40-day or potentially even an 80-day cycle trough formed in the first week of April, which would indicate that that would be a B category trading opportunity, and I would therefore not want to enter into that short trade. How do I deal with that? What I do is I watch the market very carefully, and I don't set a stop order at exactly the level of the FLD. I watch the market carefully and I see what it is doing, and I wait until perhaps a price just touches the FLD, and then I consider the situation. If that happens today and price plunges down over here, then I wouldn't have wanted to have entered right down at that level. If it happens on Tuesday at this level, again, I would not have wanted to enter there. Wednesday, probably also not there. Thursday, I might have wanted to have entered into a short trade at that level, but I will probably watch the market as it approaches the FLD. And if it finds some support at the level of the FLD and looks as if though it's going to bounce up again, then I might set a short entry level below the low of the day, potentially. Or I might step back and say, oh, I'm not sure, too much analysis uncertainty. If it forms a nice little level of support here, then I know that if it drops below that support, that is the point at which I want to go short. Okay, if it finds some support at the level of the FLD, then I would in fact start considering getting into a C category trade. So I hope I've spent a little bit of time trying to explain that, because analyzing markets using Hurst cycles and trading markets involves a good degree of subtlety. It's something it's not entirely black and white. I believe we have a short trading opportunity coming up in the S&P 500, but I am going to be a little bit careful about entering into that short trade, because it is also possible that, as I've mentioned, the 80-day or 40-day cycle troughs formed in the first week of April. I hope those subtleties are clear. Please send me comments in the Academy, or get onto Hurst Chat and send me messages if you feel this needs more clarification. I've tried to highlight some of the ways in which you can still make a clear trading decision, a confident decision, even though there is some analysis uncertainty. Let's go and quickly take a look at the euro, because there is also some analysis uncertainty in the euro, although it's a different analysis uncertainty, but we can make very clear trading decisions despite that analysis uncertainty. Now, on Friday, I wrote on the blog about potentially whether the euro is forming a very long cycle trough, perhaps even a 9-year cycle trough. And there's been a lot of discussion about that, which is great. I don't have completely black and white opinions about analysis. I believe it's important to consider an analysis and to mull it over in your mind, raise ideas, discuss them. I think that's very important to help you to make correct trading decisions. And so I'm not completely married to the idea, if you like, that the 9-year cycle trough is forming in the euro at the moment. I think it's a very interesting idea, and I'm watching the markets with great interest. But my consideration as to whether a 9-year cycle trough is forming in the markets does not stop me from making good, profitable trading decisions based on price interacting with the 20-day FLD. Okay, that's a very important point to make. I don't want you to be sitting on the sidelines because you think, well, maybe a 9-year cycle trough is forming, therefore, obviously I must only go long, I mustn't take any short trades. That's nonsense. You must continue to trade the interaction between price and the FLD, and the longer-term analysis considerations perhaps inform that, or they provide a background to what's happening. But largely, I believe it's important to keep the analysis slightly separate from the trading. So you can go and read my blog post about whether the 9-year cycle trough is forming in the euro, and look at the comments. There's some very interesting comments on that post, and you can make up your own mind as to whether you think the euro is going to consider going down or whether it's going to turn at the moment. But in terms of making trading decisions, don't let that analysis consideration get in the way of making confident trading decisions. Let me explain what I mean. A trough of some magnitude formed in the second week of March. You can see that in this analysis it was a trough of 54 months magnitude, but that's not important. I'm just going to cross out those diamond markers there. It was a trough of, I believe, at least 80-day or probably 20-week magnitude. And so what has followed since then has been a very good, clean M shape. Can you see that M shape? Now that's the shape that cycles make in the markets. What cycle is that? That is very simply the 40-day cycle, because here is the 40-day cycle, nest of lows. And so regardless of the magnitude of the trough in the second week of March, we have seen a very clear M-shaped 40-day cycle forming. And we have been able to trade that cycle. So regardless of whether the 9-year cycle trough is forming in the euro to US dollar, you should have been able to make good, clean, clear trading decisions. And in fact, in my last Hurst Trading Room video, which was 2 weeks ago, I took a break over Easter. The last video I mentioned, and it was on Monday of 2 weeks ago. Let's just zoom in here and take a look at this. I mentioned that I expected the euro to find support at the level of the 20-day FLD, because here was our A category interaction and this was going to be our B category interaction. Go and take a look at that video. It was the video on the 30th of March. I mentioned that I expected the euro to US dollar to find support at the level of the 20-day FLD. There's the 20-day FLD. I've just drawn over it so you can't really see it, but there it is. And price, as you can see, in the euro did find support at the level of the 20-day FLD. Exactly as expected. So even though we might have been wondering about that 9-year cycle trough, has it formed, hasn't it formed, it didn't matter. The important thing is the price did what it was expected to do at the level of the 20-day FLD, which is where we are trading. And of course, as it found support, that was the B category interaction. As it broke away from the FLD sometime last week, I beg your pardon, the week before, that was the C category interaction, of course. What came next? The D category interaction, which is the short trade as price interacts with that FLD. And that turned out to be a fantastic short trade. Now, this analysis, the FLD is slightly displaced because of the longer term cycles. Let's take a look at Hurst Signals. I think I have a Hurst Signals chart here for the euro to US dollar. There it is. And let me zoom in. You can zoom in on a Hurst Signals chart simply by clicking on the chart, and you can see a much bigger version of the chart. There we go. And let's take a look in detail at what was happening on Hurst Signals. You can see here Hurst Signals considers the magnitude of this trough in the second week of March to be 40 weeks. But as I've mentioned, I don't sweat the details too much in terms of those longer term cycles. The important thing in terms of our trading is the magnitude of of the trough in terms of was it at least 80 days. All right, because we know that our sequence of A, B, C through to H starts with an 80-day cycle trough. And so this trough in the second week of March was at least an 80-day cycle trough, which means that this interaction over here, it was a slightly messy interaction, but nevertheless an interaction with the FLD, that was an A category interaction. Here is the B category interaction as price came down to the FLD and settled on it and tracked along it. The C category interaction was over here as price pulled up a little bit above the FLD. It didn't pull up completely above it, but it broke slightly above it. The D category interaction is, as you can see, over here. And there's the D category short trade entry at the level of the FLD. And so we have still been able to make very clear confident trading decisions, despite the fact that there is analysis uncertainty. What would be our next trading decision or our trading opportunity in the euro to US dollar? It would of course be an E category interaction as price breaks up above the FLD. Of course, if you think that the long-term trough hasn't formed yet and there's more bearishness to this market still to come, then you would expect price to keep coming lower, and you would expect the cycle to be distorted to the downside, but you might still consider a long trade as price came back up to the FLD. And in fact, here you can see in the Hurst Signals system, the system is identifying a potential E category long trade next. Finally, let's take a very quick look at gold. I've been speaking a bit about gold in previous weeks, and in my previous video I also mentioned that I expected gold to find support at the level of the 20-day FLD. I recorded that video on the 30th of March, and as you can see, gold did, as the euro did, find support at the level of the 20-day FLD, because I believe it is bouncing out of a 20-week cycle trough which formed in the middle of March. Let's just zoom in a little bit and we can see that in some more detail. You can see how powerful this FLD line is. I recorded the video on the 30th of March and said I expect the gold price to find support at the level of the 20-day FLD, and you can see that is exactly what happened. Price came along and straddled that FLD. So we have a perfect example of our sequence of interactions. There's our A category interaction. Here's the B category interaction. Between B and C, we expect price to track along the FLD, which is exactly what it did. C category interaction is as price breaks up above it, and the D category interaction is as price breaks down below the FLD. Oops, that's the D category interaction. That's not a very good D. That's the D category interaction as gold price comes down to the 40-day cycle trough, which it looks as if though we are expecting sometime this week, later this week, perhaps early next week. Of course, in gold, we also take a look at the peak analysis, where the peaks are synchronized as opposed to the troughs. And you can see that according to this analysis, we have a nest of highs as opposed to a nest of lows for the 80-day cycle peak, and potentially that peak over there, which formed on Monday of last week, potentially that was the 80-day cycle peak that formed in the markets. As a matter of interest, if you are a Hurst Signals subscriber, we are busy testing an analysis of gold for Hurst Signals, and here you can see them. Here is the trough-based analysis, and you can see the sequence of interactions, as I've just indicated. The A category interaction, B as price came down to the FLD, C category interaction as it broke back up again, and as you can see, the system says the current price is possibly category D at the moment, and we are also considering a peak analysis in gold. Here we go. And you can see the same thing over here. Here's the identification of the interactions. There's the F category interaction, G and H, and here is the nest of highs for the 80-day cycle peak, which looks very much as if though it potentially formed last week on Monday. So if the 80-day cycle peak formed last week on Monday, then of course we are expecting gold to move down a little bit over the next few weeks. And so certainly the short trades in gold are probably going to be the most profitable trades over the next few weeks. Thank you very much for joining me in the Hurst Trading Room. I wish you profitable trading and look forward to seeing you next time.